Welcome back in, everybody. So in this video, we're actually going to do a subscriber request on a company called Celsius. Now, if you're new to the channel, we do fundamental analysis and long-term price action. And today we're going to go over a few different stocks here that have been called out on the channel. So if you like this type of analysis, make sure you like and subscribe, and welcome into Compounding Capital. Now, if you're not familiar with Celsius, they are in the functional beverage category. Everything from energy drinks to liquid supplement, and they supply in the United States, Australia, New Zealand, Canadian, European, and Middle Eastern countries. For these functional beverages, they offer many different flavors and categories depending on what your objective is. This business is growing extremely fast, but it is coming into some hiccups. And when we look at the price action on the stock, it's done a full circle here. So now we have to start looking at valuation. Is this an opportunity or is this a trap? When we look at sentiment around the stock, pretty wild differences here, from $26 as a low all the way up to $99 as a high. High variance with a small cap growth company here. One thing's undeniable about this company is they've grown extremely fast, doing $75 million of top line revenue in 2019, now doing over $1.4 billion in revenue, pushing $1.5 billion in revenue. Now, I think we're starting to see, with the price slowing down, that maybe it's starting to get to that point where it's harder and harder for it to grow right now. When we look at this chart, we can see that that growth rate has actually reflected in the price action here, jumping all the way up to $92 and hitting basically a double top, and then selling completely off from that standpoint, rounding back to a $30 range here. Trading at a forward P sitting at 37.5 times. Obviously not the cheapest stock out there, but there's not many stocks out in the market growing as fast as this company, and has actually some fundamentals underneath it. It's pretty rare to see a $7 billion market cap company growing at 50-60%. having some fundamentals underneath it and still growing at a high rate. So at some point in time, we kind of have to look at this round trip going from $90 a share down to 30 and say, is this an entry point we want to take a look at? The other thing I want to actually point out here is, even with that tremendous growth, they finally have some earnings behind them. They have some free cash flow, and yet the stock has now round trip from 90 down to 30. So as the fundamentals have gotten stronger, we've seen the price action actually come down. We have 1 sell rating, 2 holds, 4 buys, and 9 strong buys with a potential upside of 73%. Now, I just look at this from a sentiment standpoint. I personally don't care what anybody's saying. I'm going to use my own growth rates. We're going to start plugging in these numbers for Celsius. Again, before we start plugging in our numbers, the one thing I want to point out is Celsius stock has plummeted to a 52-week low, is definitely bouncing off of those lows as we're getting some more buying pressure coming in here, and actually getting some possible valuation understandings around this company. And so what I want to point out is Pepsi is now ordering a lot less from Celsius, and that's going to be a pretty substantial hit to their top line of $100 million to about $120 million of revenue, and this is definitely putting a damper into what we have to project out forward. They're going to do a little over $1.5 billion this year, but 2025 they're projected to grow around 18 and then 17%. So we're seeing those growth rates coming down, but we're also seeing strong earnings growth following that, as the fundamentals are getting better within this company. Over the next 5 years, we get a similar setup when we talk about Yahoo. Yahoo's expecting them to grow around 16% over the next 5 years. So I feel pretty comfortable using about 12 to 14% growth rates here, just building a little bit of safety. As we know, the Pepsi orders are slowing down. We do have a slowing consumer as well. So there's a few reasons why I want to err on a little bit of caution on this one. This is one of your discretionary items, which I don't think does well in the economic cycle we're heading into. So that's why I'm looking at companies like this to be buying, as we understand valuation with this company today. But as we know that the consumer could be slowing down, and we could see actually more downside risk, as this is a company that's kind of been a falling knife. It keeps hitting new 52-week lows, and I'm not seeing any sort of catalyst that could turn that around anytime soon. So understanding valuation is extremely important. Taking a quick look at their balance sheet, they have $755 million in cash and cash equivalents. Total debt sitting at $2 million. Extremely clean balance sheet here. They are diluting here a little bit, but nothing that's really eye-opening to me. I think overall, this is pretty reasonable for a growth company and a low market cap company here. So when we compare profitability to their peers, they clearly have a competitive advantage here, as we look at net income tripling kind of what their peer comparisons are doing. Very strong margins in this business, which means that you could actually pay a little bit of a premium here. So let's take a look at valuations. Now, they're trading at 25 times forward EV to EBITDA versus industry standard sitting at 11 times. But let's compare that to a Monster Beverage. Monster Beverage is trading at 22 times. And then let's throw Pepsi up there to kind of get an idea of what they're trading for on a multiple to EBITDA. Pepsi trades at nearly 16 times. I'm actually comfortable using about a 16 to 17 multiple on this stock. So with a 17 multiple, basically putting a multiple below Monster Beverage and in line with a Pepsi. Now, I'm not saying this company is Pepsi, but the growth rate and the margins make us have to look at this as a company that has a competitive advantage. Their margins are dominating their competitors. So we do have to pay up for this, and because they're in an early stages of a growth rate, there is sometimes a premium we have to look at when we look forward towards 10, 15 years down the road. Is this a company that will still be outgrowing? And indicators are pointing to yes, but that's not always necessarily true. So using 13% growth rates, 12% growth rates, and 9% growth rates, really undershooting kind of what expectations are and putting roughly a 17 multiple on the stock, we're looking at a $32 stock. And where is the company currently trading? Currently, the company is trading at $33 a share, and we can see that big fall off that we've talked about, that double top. And we talk about Pepsi not buying as many orders here. There's a lot of bad news baked in the stock, and I actually think it's hitting a pretty interesting point at these levels. Now, we know there's a really clean balance sheet here, $755 million in cash, nearly no debt, and this is a company that is starting to free cash flow here. So a lot of positive signs in early stages of a growth company, and we can see that de-risk has definitely happened. This was a stock that was trading at $50, $60, got as high as 90, now down 30, even though the fundamentals are actually starting to strengthen here. For me, this is actually a pretty solid call out here. This is a company that's growing at a very high rate, could have some hiccups here in the next 1 to 3 years. But when we look at the balance sheet, when we look at what they're free cash flowing, when we look at the relationships that they have, there's a lot of things to like. And then we look at the fact that the fundamentals has strengthened while the price has come down. Margins are growing, free cash flow is now there. A lot of things to like about this business, and I think there's a lot of opportunity to the upside. I do think this is a strong buy between 26 to right around $32 a share. So that's about where I'm putting my price target. It's hit those levels. I think you can start averaging in around 32. If it breaks below 30, I think that's where the opportunity really lies for this company long term. Although we are heading in a part of an economic cycle where this could be some risk to this stock. We could see sales actually decline, but pretty interesting positioned company here, especially when we look at the relationships that they have. So next, I would like to update my Disney analysis here, as I've done Disney analysis a few years ago, and I thought between $75 to $80 a share was an ideal price target to get in Disney, and you've done pretty well if you were able to kind of buy the dip on Disney. But now I want to reevaluate everything and kind of see where Disney is from a valuation perspective, going from today and looking like 7 to 10 years out. So when we think about Disney, there's so many different segments we can think about, whether it's the parks, whether it's the cruises, whether it's the hotels, but then also we have the streaming side of business. Obviously Disney and Disney Plus, Marvel, Lucasfilms, ABC, FX, Fox, National Geographic, and many, many more. And one of the most underrated assets that I think is under the umbrella is the ESPN and ESPN Plus that Disney also owns. So when we think about Disney, obviously the first thing that comes up is the parks. Then we have the cruises, then we have the hotels, then we have the merchandise, but we also have the streaming side that's actually starting to get pretty interesting here. They're basically the second company to now be profitable in streaming, and I think this is just the beginning with the new hits hitting the market. So when you're buying Disney, you're not only buying all the parks, all the hotels, all the cruise lines, all the merchandise, the big moat that Disney has, and the great management that is in place, but you also have that streaming side that's basically getting discounted to almost nothing. We're talking about brands of FX, ABC, Disney, Disney Plus, Marvel, Lucasfilms. Having all that under one umbrella and then looking at the valuation of the stock, I really think if you broke Disney apart in many different segments, whether you were selling the hotels separate, the cruise line separate, the parks separate, the merchandise and the mouse separate, and then the individual films, and you were to spin off all of streaming into separate categories and added together, are heavily discounted if we were to sell them separately. And just to put it in perspective here, Disney has an enterprise value of $205 billion, and when we compare that just to a Netflix, the enterprise value on Netflix is $306 billion and the forward PE is 31 times, which means Disney is actually 50% cheaper than Netflix, but offers you an array of different products and services. It's not just linked to one thing of streaming, and they've just entered streaming and they're already starting to grow massively on the streaming side. I definitely think they're going to be a competitor in streaming, no questions asked, and you're basically buying the parks and getting the streaming for free if we were to look at the business as a whole. When we look at Disney's price analysis and the sentiment around the stock, you have a low of $94, a high of $140. Currently, the stock's trading between $85 to $90 a share, right now sitting at $90.55. When we look across the board, very strong top-line revenue growth, growing from $69 billion in top-line revenue, now pushing over $90 billion in top-line revenue, so nice top-line revenue growth. But is earnings following? This was a company that was earning $6.68 a share and now is only earning $2.61 a share. A big part of this is CapEx entering the streaming world. There's been a lot of spending to enter the streaming world, keep up with the parks, and actually grow more into other countries. So we've seen earnings kind of take a hit, but forward guidance is stating that earnings are going to strengthen as CapEx is going to slow down, as streaming becomes profitable, and they're getting their EBITDA margins back on track. This was a company doing 20% EBITDA margins, and then it tanked, but now starting to push back above 18% EBITDA margins. So we're starting to see margin expansion within the business, and we're actually starting to see some aspects of the business become more efficient. Now, the hardest part is putting a multiple on Disney because there's really nothing to compare it to. It has streaming, it has parks, really heavily integrated into consumer discretion. It has hotels, it has cruise lines. And so when I think about that, it's really, really hard to put a multiple on it. You have something like Netflix that trades at 25, 30 times a multiple to EBITDA. And Disney's trading closer to 15, 16 times a multiple to EBITDA. And so when we get that, when we do that price action and we update our analysis on Disney, we can see here from a free cash flow standpoint, we're looking at our $70 stock, but from a multiple to EBITDA, we're looking at an $88 stock. So anywhere between that $75 to $85 range on Disney, I just think makes a lot of sense. A tremendous amount of upside here, because when we look at that, they're in the infant stages of really getting streaming off the ground and they have so much to offer when it comes to the consumer, I definitely think they have a chance to be one of the best streaming platforms out there. And then you just have the parks, the hotels, the cruise lines, and everything else that comes with it. You're getting a lot for the money when it comes to Disney. And when we compare it to Hilton or we compare it to a Netflix, you kind of have the best of both worlds at a discount with Disney. And so I definitely think that's where it makes sense to take the risk on in Disney, between that $75 to $85 mark. As always, ladies and gentlemen, appreciate it if you like and subscribe, and we will see you in the next one.